What's up, man? Yes. Welcome back to the channel, Gerald Peters. Always remember, whatever it is you think about comes about. Whatever you focus on, that's what grows. I was talking with a guy who's trying to get into investing. You can go to work and you can do your 401k, and I'm sure they'll give you a brochure and they'll tell you what to put it in. But man, and if you're going to go about it yourself, kind of like I do, self-directed, you have to open a brokerage account. It's like a super checking account. It's not that complicated. Well, probably everyone that watching this has one, but in case you don't, that's it, man. You gotta connect a regular bank to something like E-Trade. I guess you could open an E-Trade without a regular bank. I hadn't thought about that because you can get a debit card and a checking. I guess you could wire it, mail it in, but most of the time you're going to transfer money from your checking to your brokerage. With a brokerage account, you can get a debit card, you can get checks, but when you first put money in there, my opinion, from my own mistakes and the problems that I've had and watching thousands of people being in the Money Flow Trading Society in our Discord and just talking to tons of people, writing about this, trading every day. I watch the markets, virtually every day. Read about it, before and after, track charts, that. Manage my own money. And that's kind of what I in my mind is like, I make money with money. So I collect rents. I have equity positions. As mortgages are paid down, equity goes up. You could borrow that, or if you sell the house, they give you that, you get it in a check. Collect dividends. If you have any business, I sell books. And make money with money, and you want to see where's the best opportunity. But this guy's trying to get going in stocks, and it's like, well, you need a brokerage account. And we could back it up and say, you got to get your buckets right, but let's not get hung on that today. It's like, because what good does it do you to invest if you're going to turn right around and take it out when you need new tires, or you need to go to the doctor, or whatever. So one of the basic tricks of investing is this money has to be money that you're not going to touch. It has to become sacred. And, one of the differences between investing in stocks and real estate, I do both, is you can get into stocks, books like crypto, $5, man. There's brokerages like M1 Finance. I think it's $10 is the minimum. And what you want to try to do, and this is just advice, and I was writing this down, is like in the first few years that you're in the stock market, you should avoid the lure, honestly, of like penny stocks, options. What else did I write? Oh, margin, Forex, futures. Man, if you could avoid that for the first couple of years. Now listen, I'm not saying forever. We're going to come back to this, but what if we come back to stuff like margin, and we have 1 or 2 years in the market just investing in, say, index funds or blue chip dividend stocks, and every day you're reading and you're studying and you're learning about charts and how to value companies, and you make a real fucking conservative effort. And instead, instead of getting out there and trying to do dumb shit, you focus on training, learning, building, and build a base or a foundation. And I'm being serious, and really doing that for the privilege of doing that, because you can. There was a time where, hey, if you're a woman, you couldn't buy fucking stocks, man. That was for a lot of people. And when I was young and looking at stocks, it was $60 to buy and $60 to sell. That's a $120 turnaround. Today, it's fucking free, dude. Boop, boop. You got thumbs. But part of your study should be a little bit about history. So, and I want you to understand that beating an index is not easy. And if you just buy the S&P 500 or the Dow Jones Industrial, I like the Dow Jones, man. The Dow Jones Industrial was created in 1896 by Charles Dow. Fascinating shit, and I'm going to tell you why. Dow initially calculated the averages as a simple arithmetic mean of prices of 12 prominent industrial stocks. A lot of railroads in there. There wasn't as many companies. As you know, today we have, 30? These companies were chosen to represent various sectors of the U.S. economy at the time. Dow added up the prices of the 12 stocks and divided by 12 to get an average. Over time, the composition of the index changed, and today it consists of 30 large cap publicly traded companies. The index is calculated by using a price-weighted methodology where stocks with higher prices have greater influence on the index's values. I like indexes. And if you manage your own portfolio and you buy stocks in different sectors that are on sale and you have some sort of strategy, and these are quality companies, you basically are creating your own fucking index. You know, the S&P 500 is 500 stocks, and I think the Russell's 2,000 or 1,000, and the Qs are 50. The Dow is fascinating though, because Dow and his partner named Jones, Dow Jones, they created the Wall Street Journal. He had this newsletter, and he's the first guy to kind of take that and publish it and, send that shit west. West to people who didn't live near Wall Street, man. So it's part of history. These are the kind of things you should learn during your 1 or 2 years that you're avoiding penny stocks and these things. And you put your money into just like an index fund. You put it into, here's what I was going to say. We're going to talk about a strategy off of Dow's. As time goes on, they create a strategy called Dogs of the Dow. And if you have my free ebook, you can read on that in chapter 10 called Dog Power. But understand, we don't want to avoid or ignore some of the more risky parts of the market forever. Like there's a time to use margin, but let's get our skills up. Let's get some money in there first, man. Let's learn. Just while we learn, part of me wants to tell you just play some of that riskier stuff with small money. The problem is if you're like me, you won't do that. You're going to go and fuck up, man. And that's why I'm trying to get you not to, because I did that. Playing does teach experience, and who knows, you might get lucky. And for a small group of people, that might be okay. But a lot of times I find is like while you're trying to learn, trying to do basics, you're out here playing penny stocks, trying to short this and do this. You're just developing bad skills, man. And you're not learning proper risk management. You're not learning about proper ways to place stops and a proper exit with profit, tracking shit for taxes. You may not be thinking the right way. You might just be out there YOLO fucking gambling. And when you're doing that, you're just wasting time. And if you win, you're going to buck it off anyway. So why don't we just start the base and build it so that we can play this game forever? If you keep 75% of all your assets in shit like single-family real estate, multifamily real estate, income-producing land, blue-chip dividend stocks, bonds, shit like that, you're just going to stay rich. And you can take the drips off of that, the interest payments, the rent payments, the equity you borrow out, and you can put it into things more risky, Matic coin. We like the cryptos, Bitcoin. I'd rather put my renter's money in Bitcoin, take my money and put it in a real estate, or put it into 3M or AT&T or McDonald's or Pepsi. They're going to be here the rest of my life. It's a no-brainer. I've blown out margin accounts, Forex accounts, option accounts. I've lost small fortune, quote, betting on penny stocks. And I emphasize betting because that's exactly what it was. But now I feel like I've matured a lot. I've been in the markets for 20 years. I approach penny stocks a lot different. And if you've ever read the PetersReport.com, if you go to page 35, I usually have my whiteboard. You'll see 1 or 2 penny stocks we're watching. But I'm using the money flow trading system. I want to try to buy some in a stage 1, and if it breaks out, cool. We got to stop strategy. When it hits, I'm going to take some off. And, you know, if it goes against me, I'm assuming the risk that I'm assuming. And I know, okay, this is a penny stock. I don't want to put 10, 20, 30% of my net worth or my money that's in the market in. I want to put a very small amount. I was writing over here, what was it? If any one stock went to zero, never lose more than 1% on any trade. So anything speculative that I'm buying, I mean, you know, what is the chance this goes to zero? And if it's an investment, you know, to yourself, say this, like, why am I doing this? Why do I think it'll go up, both technically on a chart, but also fundamentally? What is the value of this? What sector is it in? What hole in my thesis is this plugging, or in my portfolio? Like, does this even make sense what I'm doing? The dogs of the Dow is an investment strategy that involves selecting and investing in the top dividend yielding stocks from the Dow Jones Industrial Average. The strategy typically involves selecting the 10 highest dividend yielding stocks from the Dow Jones at the beginning of the year. What are those right now? Let's see. Amgen, Big Pharma. Cisco, Hardware Tech. CVX, Chevron. So the Amgen is in what? The XL, what is the, whatever the biotech ETF is. Cisco's in the QQQ, also in the XLK, right? Chevron, oil, XLE. Dow would be industrial. IBM, another tech. Johnson & Johnson, I'm assuming like consumer staples. Coca-Cola, consumer staples. 3M, more industrial. Verizon, right? And then WBA. WBA made my highest conviction list this week. So those are the 10 stocks that are in the Dow Jones, or in the dogs of the Dow. The dogs of the Dow come from the Dow Jones. Dow Jones comes from this dude named Dow, who created the index in 1896. And you're getting in, man. Then you came across me, who created this idea of the money flow trading. So all these things, man, this shit is fractals. It's all laid on top of each other. Ask yourself, why are you buying a stock? Why do you think the price will go higher or will drop lower? An example is the stock is undervalued. It's a blue chip stock. I mean, it's a multi-billion-dollar stock. It was in a stage 4 decline. It's now trading below its fair value. It's put in an anchor point. Prices began to move sideways. I've got at least 4 days, and price is above the 5-day exponential average. This, and if you're in a portfolio, you're like, okay, do I have a lot of stocks in this sector? If so, maybe I don't do this deal. But it's like, no, this is filling a need in my portfolio. I like this company. And so now if it's a trade, what are we going to say? All right, where do I know I'm wrong? Am I willing? Do I want to bail? And maybe you say, okay, I'm going to put half a stop loss below the anchor point, and then I'm going to move it a little bit more, and it's going to have to go a little bit more to kill the deal. That way, in case it comes right back. So, and you can sit and plot and think this through, and then boom, now we got a trade, man. And that could be with $100, that could be with $1,000. And if it's a buy and hold, we don't need any of that. We already have our criteria. It may be a stock you already own, so you already have a reason for owning it. Like you have a position in cars, and that's Ford or Tesla. You get what I'm saying? And now it's a stage 1, and you're seeing it, and this still holds a place in your investment portfolio, and you're gonna put money in there. So you're taking your time, your talent, your energy. You went out into the world and you worked, man. You made money either through your own value or your time, and you have it. And now you're investing it. And that's precious. So for my advice is, and what I came on here today to say, and tonight, your first few years in the stock market, man, avoid the lure of the pennies, okay? Avoid the lure of options and margins and Forex and anything where you're going to blow the fuck out. Even though you can make a lot of money, and I'm not saying forever. I'm saying let's get some skills. Let's learn, practice, make sure it's what you want to do. You know, you can practice trade, but start building that base of high chip, blue quality companies. The Dow's a great place to start. They've been doing that since 1896. Dogs of the Dow have been going like 60 years. We've been doing the money flow trading system. This thing is fractal, and we want to build a base of wealth that's going to live on past you. And then as we get skills, get more confident, we start practicing our trading. Let's get out there and use that margin to our advantage. You know, maybe we'll use some options, and we've got some penny stocks. I mean, I got one I'm up 500 and some percent in CLSK because of my thesis in Bitcoin, which Bitcoin is a blue chip. Used to be speculative, now it's a blue chip. And so you can have money in Bitcoin. That's a brainer. And you can trade it, okay? And in that sector, there are risky coins, and then there are ones that are considered less risky. So, but learn, okay? But my advice is focus on the easies, focus on the index and the layups and the utility companies, and just build yourself a base, because that'll keep going. And then when you go out here and you take some risk, when you hit it, you make a lot of money, you know what to do with it. And if you lose, you still have that base. And so you get to play forever, man. God bless. Hey, if you need anything, let me know. Hit my bio link. Go to geraldpeters.info and get my free book. You don't have to die broke if it'll help you. And if you got it, go back and read chapter 10, man. In your homework, go look up Charles Dow and look at how the Dow was created, man. Let's go.